Welcome to Mentor Conversations at SCORE Houston, where we bring you insights and stories from our mentors. You'll hear from senior executives, entrepreneurs, and professionals who volunteer their time to guide small businesses. SCORE is America's largest network of volunteer business mentors and is supported by the U.S. Small Business Administration. In Houston, we provide free, confidential mentoring and education to help entrepreneurs start, grow, and succeed. Now, let's dive into today's mentor conversation.
Welcome to SCORE Houston podcast. I'm your host and mentor PV Bala. Today, we are joined by a true pillar of the Houston business community, Jeffrey Jones. With over 35 years as a SCORE mentor, Jeff brings an unparalleled depth of knowledge in the intricate world of business transitions. He is the president of Advanced Business Brokers and Certified Appraisers, where he specializes in the valuation and sale of small to medium-sized firms. Whether we are looking to exit your company or acquire a first legacy, Jeff is an expert to understand exactly what makes a business bankable and sustainable. Welcome to podcast, Jeff.
Thank you for inviting me.
How entrepreneurship has changed from then to now?
Well, the concept of entrepreneurship hasn't changed, I don't think, but the tools that we use to operate businesses have significantly changed. Operate our business in brokering businesses has changed significantly. In times past, when we had a business for sale, we'd run an ad in the Sunday Chronicle. Today, there's not even that section in the paper anymore. It's all, everything's done on the internet.
Yeah.
Again, back many years ago, we made everybody come to the office to get information. Confidentiality when you're buying and selling a business is critical. And to ensure people didn't just show up on the doorstep of the business owner, we require they come to our office so we get to know who they are, have them sign a confidentiality agreement. And then we would give them packages on businesses that we had for sale.
Yeah.
But again, with the internet, everybody wants to do things from their home or office or wherever. So that has changed our business dramatically. So now we do a lot of it by email and through the internet. Confidentiality is still critical. And so we do require, before giving any information about a business, we require that they give us all their contact information and have them sign a confidentiality agreement. Then we can provide a package that describes various businesses that we've got for sale.
But is there any preference for certain types of businesses that you focus on?
We're basically what we call a Main Street broker. That is, we handle small to mid-sized companies that you would typically see on Main Street. We deal in size businesses ranging anywhere from 50,000 to 30 million. But our average deal is probably in the $300,000-$400,000 range price-wise, and it covers a broad spectrum. We do probably a third of our businesses we have for sale are restaurants, because there's in the Houston metro area, there's over 7,000 restaurants. At any given time, 25% of them are for sale. But we handle a little of everything. Manufacturing company, businesses we handle pretty much the same percentage that they represent the industry. Service businesses represent about 35% of total businesses in the Houston area. Manufacturing companies, which we get a lot of inquiries for, but manufacturing in Houston only represents maybe 7% of all the businesses that are out there. Retail and service are the two most popular types of businesses. In terms of businesses that people want, wholesale distribution type businesses, manufacturing businesses, business to business businesses are our most popular. Like a lot of our buyers are coming out of the corporate world, tired of working for the big company, want to get into their own business. And their preference would be to get into a business where they're dealing with other business customers as opposed to retail. And so our probably 65% of all of our buyers' preference would be a business to business type business as opposed to retail.
Are you seeing any demand moving up for manufacturing? The government having so much of focus on manufacturing, do you find small manufacturing companies coming in? Are there opportunities out there?
Yes, the government has emphasized manufacturing. They have some now unique government programs for financing Basically, in some cases, you can get in for low or nothing down and get pretty long-term financing. So there's a lot of incentives to get into manufacturing these days.
Exactly.
Again, in terms of acquiring them, I haven't seen any significant increase in the actual number of manufacturing companies.
I just trying to
Yes, many,
understand.
many of they're oil and gas executives. Many of them are engineers, so they have a technical background. And in many cases, they have little or no business experience other than the technical aspect of their job.
Yeah.
That they reach a point where they get tired of being transferred overseas all the time, or
Yeah.
the company keeps changing hands and they're downsizing or upsizing, and so that causes people to leave. And the option would be to get into their own business. Now, in the Houston metro area, every year there's about 60,000 startup businesses.
Yeah.
Houston is an entrepreneur capital of the world. I think there's more business to start up here than most any place else. And in part because it's easy to get into business here. Rents are reasonable. There's a lot of locations available. There's lesser government regulations on businesses here in Texas. And so there tends to be a lot of people who, the options are to get into business for yourself is to either buy a franchise, buy an existing business, or start from scratch. And again, that 60,000 people start from scratch every year. Unfortunately, 50% of those people don't make it the first year, and 90% are gone after 4 to 5 years. So it's a highly risky business to start a brand new business. And based on our experience of businesses that we've sold over the years, 7 out of 10 of all the businesses we've sold are still in business. And so it's much safer to buy a business than it is to start one. But most of the books that you find on the bookshelf about getting into business relate to starting one. And that's what most people tend to do. There's only about, somewhere every year, maybe 60 to 100 businesses that change hands in the Houston metro area. But 60,000 startups. Houston is very active in terms of entrepreneurship. And a lot of people take a risk of jumping into business, many of which aren't fully prepared, and unfortunately don't take advantage of some of the SCORE counseling services that are available. And if they did, they'd probably be much more successful.
But if I had to take actually the kind of clients I have been getting and what I've been seeing, it's a lot more of B2C than B2B kind of business clients that are coming in. Is it something peculiar? I mean, like you say, there's a lot of B2B happening, much more in Houston now.
Well, I'm just saying that's one of the more popular types of businesses. In Houston, there's all kinds of businesses out there, certainly B2C, probably more of those types of businesses than anything else.
Yeah.
People do get into those businesses. Just from our brokerage standpoint,
Okay.
it just seems like the majority of the people that come to us, because they're coming from a business background,
Yeah.
their preference typically would be a B2B type business. Now, if they're buying a business for their wife or children, then they sometimes will then expand that horizon into other service-related businesses that are more directly related to retail customers. Frankly, it's less risky to buy an existing business already making money than it is to start from scratch. Again, over 90% of startup businesses fail. It is much safer. Of course, the problem with buying a business is you got to have a little more money up front. Sometimes you can start a business on a shoestring. The amount of money you got to put into it before it makes any money is what causes most people to go out of business. They greatly underestimate the amount of working capital needed to launch a new business and get it to a level where it's making money enough for them to make a living. Whereas if you buy an existing business, presumably you're making money day one. Financing is much easier for an existing business. Trying to start a new business to get financing, banks don't like startup type businesses generally. They will finance new franchises because they're at least a proven concept. But many of these small startup businesses aren't really proven. So banks don't want to finance many of these small businesses. But if it's an existing business and can show profitability, people can get into that business for, in some cases, for as little as 10% down, but somewhere between 10 and 20% down. And then through the SBA program, they can get a loan for 10 years, which keeps the monthly payment pretty low. Relatively short term, it's actually much cheaper to buy an existing business already making money than it is to try to start from scratch.
So when you're supposing hypothetically, if you're looking at buying a business which is operating for last 10 years, 15 years, profitable business, but there is not much of fixed assets or land. Okay, so I come in as a buyer and say, okay, I would like to buy. Now, would SBA provide a loan without much of collateral, either from my side or the business itself is not able to provide too much except for profitability? So, will they go by the business or they want some fixed assets to mortgage or something like that?
Well, the value of any business is either the value of the tangible assets or some capitalization of the earnings, whichever is greater. And if that capitalization of earnings gives me a value for the business, and that's what the lenders look for. As fortunately today, through the SBA program and their guarantee to banks are willing to make an existing business that has little or no assets, and maybe just strictly a service type business.
Yeah.
That loan is based on the cash flow or profitability of the
Okay.
business itself, which is another advantage of buying a business is that you can buy one that may have little or no assets, but as long as it has established customers and a cash flow,
Yeah.
we can get that financed.
So you could come in with a, let's say, owner's equity of the buyer's equity of just about 10%, and then rest managing for the lenders, SBA loan, as well as the bank's working capital. Is it still manageable?
Yes. The advantage of the SBA loan typically is a 10-year loan. So that keeps the monthly payment relatively low. And that's, of course, one of the criteria for the lender is that is there enough cash flow from the business to one, pay the owner a salary, and then two, pay the note that they're going to have.
Yeah.
And that's sort of the lender's criteria. And if it meets those two criteria, sufficient cash flow, then they'll make the loan.
Is there a provision for the seller taking his part of his cash, which is due after 5 years or after 10 years, like through a seller's note? Is there something that is very likely as a business deal?
Well, frankly, about 65% of the businesses that we sell are sold with seller financing, as opposed because many of the small businesses, due to their lack of good financial records, don't qualify for an SBA loan. Bank requires at least 3 years of tax returns showing sufficient cash flow to that, and a buyer can pay the loan. And if the business on their tax returns are not reporting all that income, then the only option would be for the seller to provide financing. Typical seller financing is 5 years. Time we're getting it for around 6%, requiring a down payment in the neighborhood of 35, 40%. The balance. Again, over 65% of our businesses that we sell are sold with seller financing because they would not qualify for an SBA loan.
Oh, okay. Would you be recommending for someone to look first, look for a business that is available for only if it is not, then you look for starting something on your own? Is that
Yes.
right?
I think anybody considering getting into business on their own should look at all three options. They should look at starting, what the cost is to start one. They should look at what the cost would be to buy one. They should also consider a franchise. I have corporate people who have little or no business experience. They have technical experience, but no business experience, are better off looking at a franchise because they get the support from the franchisor. They're buying a proven concept, and two, they're getting training, ongoing training and support from the franchisor. So a lot of people that don't have a good business background are probably better off considering starting. It's a new business maybe, but it's a franchise. It's an existing concept. On the other hand, we sell franchises too. Probably a third of the businesses that we sell are existing franchises where somebody who's had it for a number of years sells it. So to us, it's just another resale of an existing business. Again, people who lack a lot of business experience really should consider a franchise, either starting new or buying an existing one. So those are options that I think any buyer, any presumably entrepreneur who's considering getting into business, look at all three options: starting, buying, or buying a franchise, because those are really the three ways you get into business.
Like you talked about the franchise method of getting into business, of course, it's much less risky, but you don't have too much of a control within yourself, and your return that you're going to get is also going to be quite minimal, right? Compared to running a business on your own. Yeah.
Well, it depends on who you talk to. Of course, the franchisors exploit the benefits of buying their franchise. Presumably buying a franchise in a given industry, you'll make more money than trying to do it on your own. At least that's their pitch, but it's not necessarily true. Two negatives of buying a franchise is one, you're locked into their system.
Exactly.
You can only do what they allow you to do. The other is you got to pay an ongoing, you pay the initial cost of the franchise fee, and then you pay a royalty, an ongoing royalty for the rest of your life. So those are just two issues you have to consider when you're looking at acquiring a business. If you want to acquire a franchise, there's going to be that franchise fee and ongoing royalty. But again, you're getting support that you wouldn't otherwise have. It's really has a lot to do with the background and experience of the person getting into business as to which of those three methods are the best way to get into business.
Absolutely. I agree with you. Now, for a buyer who is getting into the business, he's looking at a business proposal and there are businesses available for sale. It always gives a valuation. Now, how, the buyer, of course, my client now, he has his own method of valuing. He has used some norms and he says, this is the way I have valued it. Whereas the the seller is asking for obviously much higher. Now, there is always negotiation and they come to a conclusion and the buy sell takes place. So tell me from your experience, how much is the margin for negotiation in this deal normally?
Well, of course, ultimately the final price is what a buyer and seller both agree to.
Yeah.
And you're right. It's not uncommon that sellers have an inflated idea of what their business is worth, and buyers sometimes make offers that are ridiculous, part because maybe they're limited in terms of their own cash flow ability to pay for a business. So there is a fair amount of negotiations going on. But from a brokerage standpoint, we sell a significant number of our businesses at what we call full price, but that's meaning that we value the business reasonably to begin with. Again, every business has to make enough profit to pay the owner a reasonable salary, and then have enough left over for return on the investment, and then pay any debt service that they've got. So that ultimately is the great criteria.
Of course. Yeah, the valuation of the business. How do you help in the valuation of the business? Because there is, like you said, there is a financial cash flow, the discounted cash flow, the cost of the capital, and then you arrive at the present day value. But again, and there are people talk about, the thumb rules. What kind of a business? What is the EBITDA? So many times the EBITDA should be the valuation. Or, they talk about, say, 3 times or 4 times the turnover plus the fixed assets. There are so many methods of guidelines for valuation. So what are the guidelines that you follow in valuation?
Again, the business has to make enough cash flow to pay the owner a salary and pay a return on investment. The value of any business is either the value of the tangible assets or some capitalization of the earnings, whichever is greater. So when we value a business, and we get hired frequently to appraise businesses for people who are buying, selling, and for divorce reasons, for litigation issues between shareholders. So, but when valuing any business for whatever the reason, the first step that we go through is what are the tangible assets of the business, and what are they worth? So we do end up selling. In some cases, we can sell a business that may not be making any money, but they've got good tangible assets, and it may be cheaper to buy those assets than it would be to start from scratch. So we do get a fair amount of people who are looking for that type of business where they can they're really buying a location where maybe the rent is more reasonable. Existing equipment's already there. Well, that's one aspect of buying an existing business, is you're really buying a location and the equipment at a substantial discount from original cost. Yeah. But if it's a profitable business, but again, the first indication, we call them indications of value, and there's various methods to do that. But the first indication of value is what is the inventory and equipment worth. Then the other indications of value is the capitalization of earnings. Earnings are nebulous. There's different levels of earnings. And certainly EBITDA is one level of earnings, share earnings is another. And in most small businesses, most owners really think more in terms of discretionary earnings, meaning the total cash flow available to the owner is deducting some salary for the owner or manager to manage the business.
Okay.
So that's two different levels of earnings.
Yeah.
And when you hear multiples, so you have to understand those multiples change depending on the level of earnings that you're using. So EBITDA earnings, for instance, you might be using multiples of 3 to 5.
Mm.
Discretionary earnings, we're using multiples of 1 to 3.
Yeah.
We end up with the same value of the business. It's just depending on what level of earnings you're looking at. And again, in most small businesses, discretionary earnings are a little easier to identify. And we don't have to guess what we're going to pay a manager. It's just whatever's available is what the cash flow of the business is. There's a multitude of the discounted cash flow methods. There's a number of methods to convert those earnings into a value. And as an appraiser, typically we've got to look at 2 or 3 different methodologies to reconfirm what the value of a business might be.
Mm-hmm.
In most of the businesses that we sell, where we're using discretionary earnings, that is the total cash flow available to an owner operator, will range somewhere between 1.5 and 2.5 times that number. But that's inclusive of all the assets necessary to run the business. It isn't some multiple of earnings plus assets, which goes back to what some people try to use as a rule of thumb, and they will grossly overvalue the business in doing that.
Oh, that's right. That's right. We depend, from what you said, so much on the financial statements. Okay. That means, of course, they are audited financial statements and those should be right. But looking at those statements, are there any guidelines you will provide in terms of, look, these are red flags, don't consider this, get away from it. It could be pretty dangerous, risky for you to get into. Are there something that you look for in looking at the financial statements?
Well, of course, both as a broker and as an appraiser, those are critical elements. We have to be able to read tax returns, financial statements, and then try to verify to the best of our ability. We're not auditors. We can't audit somebody's financials. We try to at least look to see how they report and what's the validity of the numbers that they're providing. Actually, sometimes we do get owners who are falsifying their records.
Yeah.
So you got to be somewhat careful with it. A lot of small businesses, they find creative ways to expense personal expenses through the business.
Yeah.
And so that takes a little more investigation in terms of, was that a real business expense or was it a personal expense? And those are what we call add backs to discretionary earnings, is if we identify expenses that the owner is. And one of the benefits of running a small business is that you can run a lot of personal expenses through that business and it saves you tax dollars.
Okay.
But exaggerate that issue and run a lot of personal expenses that shouldn't otherwise be there. But it's one of the things that we look at, both from a broker standpoint and an appraiser standpoint, is to what extent has the owner run personal expenses through the business.
But, subsequent to coming into a broad agreement and signing an MOU, you will go into due diligence, right? At that time, you have an opportunity to go through the records minutely.
Yes, anytime we put a business on the market, we've gotten tax returns, we've gotten their financial statements, and to the best of our ability, view those and determine the level of earnings that business makes. Again, we don't guarantee it because we're using records that were given to us by the owner that may have come from their accountant, but the accountant was only reported what the owner gave them. It's important that when somebody looks at buying an existing business, that they get those financial records, they analyze them, and any questions they might have, they need to get answered of what expenses are critical to run the business and what expenses might be considered discretionary.
That's right. What do you advise, Jeff, when somebody should be approaching a broker organization like yours and when he should try to do on his own? Is there any guideline as to above certain value, it is a little more risky, so you better approach a broker? Or what would be the benefit that will come to him?
Certainly somebody looking to acquire a business, they've got an option. You can go knock on a seller or a business owner's door and say, "Hey, do you want to sell?" And if they think you're a rich idiot, they're going to throw out a number that usually is 8 times higher than what it should be. It's difficult. Our job is to find business owners who want to sell, so we can get a listing. I've got to talk to 10 business owners to find one who would at least consider selling. So finding a business owner ready to sell is a difficult task. And from our brokerage standpoint, probably the biggest time consumption of our industry is the search for business owners who are ready to sell. Everybody will sell at a given price. Oftentimes, that price is not realistic. And frankly, unfortunately, the value of most small businesses is really not great. So it's not enough to make most business owners sell. For a business owner to sell, there has to be some strong motivation to sell. They have to have health issues. They have to have sort of financial problems or some reason that encourages them to sell. Maybe retirement is certainly another one. If if that business owner doesn't have a strong interest in selling, the price will never be reasonable because that owner can keep his business, make the same amount of money in 2 to 3 years, and still have the business. Whereas if he sold it, he's only going to get a couple of years worth of earnings up front. Unfortunately, a lot of businesses never sell because they don't make enough money or they're not able to find the right buyer. They just shut down and go away. Again, there has to be one of the critical elements when talking to a business owner is why do they want to sell? Their reason for selling is to make a bunch of money. That business probably will never sell. So the seller has to be motivated. Using a broker, at least you're dealing with a business owner who's already indicated an interest in selling. So you haven't had to convince somebody to sell their business. 2, dealing with a broker, they've gotten all the financial information up front. It's always a little surprising to me to don't have current financial records. Maybe they haven't filed a tax return in several years, or they don't. We're in September and they haven't filed any statements since last year. Part of our job is to encourage the owner to get that information so that when a buyer comes to our office, we have it. That's a major issue that when buyers on their own are trying to deal with the seller's not ready. He hasn't done a lot of planning ahead of time. Doesn't have good financial records up front, and frankly, hasn't used a standard method for valuing their business. It just happens to be a number they want. Dealing with a broker, you're typically going to get a business owner who's motivated, where there's financial information available to look at.
Okay.
And be able to more quickly make a determination as to whether it makes sense to buy.
So normally, is it the case that you have a list of sellers who want to sell the business and a potential buyer will approach you, or you will approach a potential buyer offering the business for sale? Or does it work the other way around? The buyers say, look, I want to buy a business. And look, I have a proposal here. Would you help me evaluate and negotiate? So do you work in that direction also?
Well, on the brokerage side, we primarily work with sellers. There again, that's our listings. That's what keeps us in business.
Okay.
We typically don't represent buyers in that respect because they don't know what they want most of the time. Just very difficult to find a business for a given buyer. Now from where I'm doing score counseling, it's not uncommon that buyers or entrepreneurs will come to me where they've already found a business and they want help analyzing it.
Yeah.
And maybe structuring a deal. That we do as score counselors.
Okay.
There's where I work with buyers where they've already found something.
Exactly.
And they want help in terms of analyzing it and structuring a deal. There we can be a big help.
I've noticed that when clients come in saying that they have found a business and they want us to evaluate, there is a broker associated with the seller always. So
Generally,
they
yes.
communicate with the broker for the seller. So from what you said, which is true, most of the sellers will have a broker. That's how the business is conducted.
Yeah, confidentiality is so critical. It's difficult for a business owner to handle the sale himself.
Yeah.
He has to run his own ad. He has to disclose who and where he is. When somebody calls you that, he's got to tell them who and where you are. When I advertise the business for sale, we don't tell the buyer who it is or where it is. You have to until we have all their information. Oh, and they've signed a confidentiality agreement. We help sellers significantly because there's a lot of buyers out there, a lot of what I call buyer prospects, who will never buy anything. They just they look and look and look and waste everybody's time. And so a business owner would prefer using a broker who can do all that qualifications and bring to them people who are serious.
One of the last questions, Brad. What is a normal charge the brokerage, collects as fee from the seller? What is the structure of the brokerage fees?
Typically, a broker's fee, and it's considerably different than real estate, where in real estate, and the fee is really in the 6%, 5-6% range. Typically, in a business under $1 million, a broker's fee is going to be around 12%. And again, a big significant difference between real estate and business brokerage. Brokers typically don't co-op with other brokers. Brokers working directly with both the buyer and the seller. The buyer doesn't need to go get their own broker because the broker representing the seller has all the information and ultimately helps structure the deal.
True.
Now, the buyer certainly has the option of using a score counselor, in this case, me in many cases, or their own accountant or their own attorney to provide advice, but they don't need another broker because typically brokers don't co-op. As in residential real estate, almost all deals are co-opted.
Yeah. So the seller has to pay the broker on conclusion of a deal, or he pays something upfront, or how does it work like?
Well, in every brokerage company is a little different. So we've got two fee arrangements where they pay 12% at closing only. It's what we call a contingent sale, where you don't pay anything up front, but at closing, they're going to pay 12%. Offer what we call a 9% plan, where they pay 1% up front and then 8% at closing.
Okay.
So for an owner that wants to save a few dollars, taking that second option.
That's it.
But of course, they run the risk if the business doesn't sell, they paid that money up front. So we give them the option. That's up to the business owner as to how he wants to do it. So in general, fees for brokeraging a business run somewhere between 9 and 12%.
But if to make the deal possible, you found a buyer, but do you also help him in getting the loans from SBA and other lenders?
Yes, 60-70% of the time the seller is providing financing, so it's a seller note. The business does qualify for the SBA loan. We frequently help the buyer. The banks keep in touch with us all the time. They know we do deals. Will constantly send me emails making me aware of their program. When we get a buyer that needs an SBA loan, we can recommend several banks that they can go to get that loan.
Beautiful, Jeff. I don't want to take you for more of your time. It was very informative for me. Thank you so much for coming on to the podcast, Jeff.
Well, thank you. I enjoyed it. Hopefully we've given some people some good information.
Absolutely. Pleasure.
Thanks for listening to Mentor Conversations at SCORE Houston. If you're an entrepreneur or small business owner, we'd love to support your journey. You can reach us at 713-487-6565 or visit us at 8701 South Gessner, Suite 1200, Houston, Texas 77074. Our office is open Monday through Friday, 10 a.m. to 2 p.m., except for federal holidays. Walk-ins are always welcome. To learn more, to request free mentoring, or to register for workshops, visit us online at score.org/Houston. Until next time, keep learning, keep growing, and remember, at SCORE, we're here to help you thrive.